Thanks to our friends at The Motley Fool for sponsoring this video. Check out the link below, fool.com/the smattering, to get access to the 10 best stocks to buy right now. Back in 2020, I wrote an article for The Motley Fool with the headline, "The Oil Stock Subsector That Turned $10,000 into $77." For those who don't remember, the best way to describe this in the short version is offshore oil drillers essentially all went bankrupt between 2019 and 2020 during the oil crash, during the pandemic, and for a number of other factors that took place over the 5 years leading up to it. There were only one or two survivors, but here we are now, 2023, and most of the industry has been recapitalized, and we have a half dozen publicly traded oil drillers to invest in. I'm Jason Hall. This is The Smattering. And I've got my buddy Tyler Crow here with me. Tyler, is it time to invest in oil drillers again?
Jason, are you ready to get hurt again?
Don't you hate it when businesses that should be cyclical and risky, but should also be very economically productive, destroy billions and billions of dollars in investor capital?
That could be said for so many things other than offshore drillers. There's part of me that feels like this is the equivalent of Jason taking calls for his long form podcast, because I'm just like his caller calling in. I want to talk about you losing your shirt on oil drillers because I want to talk about them again.
Okay, so longtime listener, many time caller, Tyler Crow, let's back things up a little bit before we talk about right now and whether or not this is the time. We go back to 2014. Oil prices were in the triple digits, had been in the triple digits for years, and a ton of money had flowed into offshore for these offshore drillers to access those deep, really large resources that produce low-cost oil. Once you spend the billions and the years to develop them, they produce a tremendous amount of oil. But then oil prices crashed in 2014 to 2015, and we saw investment in offshore essentially dry up for years. And then the spate of bankruptcies began before the pandemic even happened. And the pandemic was basically the final nail in the coffin that bankrupted almost the entire public industry, I think with the exception of Transocean and maybe one other that didn't bankrupt, and wiped out billions and billions in investor capital. Now let's fast forward to today. And you and I have talked about it before with our videos looking at some of the oil majors like ExxonMobil, Total Energies that have gone through their own kind of repricing, sweating assets, lowering their costs, getting more benefit out of their integrated assets to drive more free cash flow. Now let's talk about applying how these companies going through bankruptcy have gone through the same thing and where things stand with the main thing that matters and the money that's flowing into offshore that they make a living off of.
On top of when oil prices were really high, all of these companies were building a lot of new rigs to satisfy those producers' demands for going in places like the North Sea in Norway, where it's what's considered harsh environment, going into deeper waters like offshore Brazil. It required a more technically advanced rig than was on the market. So they were spending a lot of money to build these new rigs, but then had all these legacy assets. What has happened since that capital spending dried up is a lot of those legacy assets got sent to the scrapyard because there's just no work for them anymore ever again.
The companies were no longer in a position where they had to keep those rigs to work because they were on their books and they had to get some sort of economic output out of them. All of the incentives to do that went away when those companies went bankrupt.
Not just that, they had to maintain them. There are costs associated with just letting them sit idle. And so finally they just were like, screw this, we're never going to be able to actually get a contract for these things forever again. So off to the scrapyard to go. When that happened, I believe over at least 7 years, the market for marketable rigs globally declined by more than 50%.
Yeah.
And so the amount of available assets on the water to drill for oil is half of what it was. And so I hear a lot of talk of, well, there's no way we can ever get back to where we were with the crazy spending of 2014. We don't have to. There's only half the rigs available. The pricing is catching up because there's so few rigs and companies want to drill for oil now. The rates for these rigs is going up much quicker because there's just less supply of them available. And as you were hinting at, because so many of these companies went bankrupt, they have the assets, but they have fractions of the debt that they had when they were publicly traded prior to 2020.
So let's take those things together. And there's another factor too, and that was that so many of those offshore drillers, they exacerbated the balance sheet issues because they also continued to pay dividends in a lot of cases as they were taking on debt to fund that CapEx for their expansion. And as the industry has hit reset, dividends are no longer an expectation. The supply and demand situation you were talking about has certainly improved. And we've seen more interest from these large international super majors to pay for development in offshore, even as a lot of them have made shale and that quick turn onshore oil a big part of their strategy. They are starting to move offshore. So thinking about where we are with the better economics, increased demand, pricing started to go up, better operating models, better operating leverage for these players. Which of the offshore drillers are you interested in?
I'll speak to the two that I have owned and ones that I have been following most closely as a result of ownership are Transocean and Noble Corporation. Transocean I actually held through all of the awfulness, and there's a little bit of a debt overhang because of it never went bankrupt, which is not as great, but because it's such a significant debt pay down schedule over the next couple of years, you're building your equity when you pay down your debt. And so there's a lot of opportunity to capture that economic value in your investment. And hopefully, as debt starts to decline, you start to get to a position where capital return can happen. Noble Corporation was one of the bankruptcy ones, and they came out with a squeaky clean balance sheet. And now, because of it, almost all residual cash flows are going to go in some way eventually to shareholders, either in the form of buybacks or in maybe dividends down the road. I think they're going to focus on buybacks for a while, just because there's no long-term commitment when we talk about buybacks versus dividends. We were just talking, you don't actually have to keep paying them as a baseline expectation for your investor base. I feel pretty good with those two, but take that for what it's worth.
One more I want to put on the list that I think is worth some additional research is Valaris. So Valaris was formerly Insco and several other shore drillers that merged together over time. They had a process to continue to merge to try to wring out some of the lower quality assets and build a bigger fleet of those advanced rigs you were talking about. And they were able to establish a pretty solid fleet of advanced rigs, but like everybody else, the overhang of everything else that was a challenge in the industry caught up and the company went bankrupt. So this is one that's a research project for me. And I suggest anybody that's interested in this space, take a look at Valaris, because I know that it's one that has some very high quality assets. And I think there is some competitive advantage to that. And being a leaner company, it could be one that's worth taking a closer look at too.